agenda is here. And these days, I can ask myself, when suddenly if a person lives in New York is in here, it's a AI avatar, is it deepfake or really there?
No.
In person, not AI or something.
In person with you guys. Sir.
Okay, thumb the table and convince me.
I'm there with you.
Okay, you're there with us. Great. Now I can ask questions. These days in AI world, you don't know what's coming up.
Yeah.
Did you see our budget coverage yesterday?
Yeah, I saw that. Yeah.
What did you see?
No, I think it is a continuation of what's happened over last 4-5 years, prudent macroeconomic policy, and I think that's where we've, as a country, upped our game. Where, if you see around us, most of the countries in the Western world, they are having high deficits, bond yields are spiking over there. So I think fairly happy with the direction we are heading in.
My question is that if things are looking so great, then why are FIs selling?
Okay. So here what we're talking, Nikunj, is of a 5-7 year outlook, and again that gives a flow to the growth. The reason FIs are selling or have not been buying as much is valuations are not cheap. You look at this quarter earnings, and this has been, I would say, one of the most disappointing quarters in last 1 or 2 years. And these numbers are not going to improve in the March quarter. See what has happened between last quarter.
Because you own HDFC Bank. If you would have been owning other stocks.
No, I'm not talking about specific HDFC Bank or anything.
Look at Titan numbers, look at Inn & Hotels.
No, again, see, those are few, but if you look at broad consumption space, leave aside parts of discretionary.
HUL numbers were bad, you're right.
So broad consumption space, you look at things being soft, basically. And what has happened is last 3-6 months, we've seen all this tightness happening on the unsecured lending also. So you'll see some pressure. But look, within a long structural cycle, you'll have mini cycles. And mini cycles will give good entry points for long-term investors. So we want the dips, we want some bit of a softness so that valuation is correct and you can deploy long-term money here.
Do you think, Rahul, that the fact that this time around there were no populist measures announced in the budget prior to the elections, that was a bit of a miss, and that was something that maybe the street and investors across the board were anticipating?
See, that could have given short-term boost to the markets, but then eventually a year later we would have gone back and said, look, the fiscal deficits are high, debt to GDP is kind of a ballooning, and that would have had a pressure on currency. So let's see this whole thing played out between 2009 to 14, where we had huge SOPs for the semi-urban rural economy, but look what happened to the currency. Rupee depreciated from 47 to nearly 65 when the Modi government came in.
Yeah. No, I just wanted to understand your outlook as well then in terms of individual sectors. Looking at the longer term, would it be capex-oriented themes that would take center stage?
Absolutely. I think capex-oriented themes, we've liked banks, and look, as Nikunj was saying, banks have not done well. But look, the pressure on NIMs would be largely behind us in a quarter or two, etc. The system liquidity would kind of adjust itself. You will see rate cuts coming through in the second half, so that's going to be positive. So continue to like banks over there. The infrastructure plays or the industry is something we like. I think there would be a time sometime in the H2 of this year that one would start looking at these consumption names. These names have not gone anywhere for last 3 years. Let's understand, 3 years back, the country was hit by severe COVID. That impacted huge businesses. For us to come out of that and completely forget the havoc it created on small businesses, on the job creation, I think it's just being a bit stretched. So somewhere, as the time passes, as inflation eases, the consumer resilience would come back, he'd start spending, and that's where some of these sectors look attractive.
But why is it, that the market is treating banks the way it is pretty much across the board?
So banks were a sector, particularly private banks were a space well owned by FIs. And look, FIs not been putting large chunks of money, large amount of inflows last years, which have come in small mid-cap funds. And I think that's where, as people venture out of these well-owned names, there has been more momentum. And what we've seen in markets over last 4 or 5 years is that wherever there is momentum, that kind of attracts more money. And that's a self-fulfilling prophecy until it breaks, basically.
My question to you is about this divided view on IT. The old timers would say, we've seen this before. Trust me, we've seen this before. Y2K, it happened. It happened in 2008. It happened when SMAC and digital came out. And AI is just an extension of a technology wave which is changing. But IT companies have seen it all. The new, breed is of the view that AI is different. It's going to cut manpower cost, and it's going to have an impact on the way how IT companies, the services companies, will do business.
So you're right, but look, what is going to happen is it is a matter of time frame. If you got a 5-year time frame, these companies would emerge out victorious, like the way they've done in the past. If the time frame is 1 or 2 years, 1 or 2 years is where the readjustment is happening. You look at what the Google, Facebooks, and all these guys are doing. They're laying off 15, 20,000 workers, and they're hiring skill sets in a new AI relevant space. So I think that is what is going to happen with the Indian IT services company also. They will go through this readjustment phase where they reorient, retrain their teams for the skills of future.
Where is it that in the current market you think there is pockets of exuberance and one needs to at least either not deploy fresh money there, even though that they may be looking attractive, or at least book profits?
I think some of these small mid caps, names which have gone up multiple times in particularly last 6 months, you don't have to do much. Just look at names which are up more than 40-50% last 6 months, and these are not really the great business models. There's a fair bit of a frothiness. I think those are the names. Everybody knows what those names are. One can easily take some money off the table.
Where is it that you see the next big risk maybe emerging? Do you think that it will be largely driven by global factors versus something happening back home?
I think what happens is globally also markets were very exuberant about rate cuts happening. If you see how the narratives change in last 3-4 weeks, those rate cuts have got pushed back, and that is something which is going to happen. But look, those pullbacks are going to be kind of a shallow pullbacks. Those are not going to be deep pullbacks because, as we've discussed before, you've not seen large scale excesses happen globally. Where you had excesses was overinvestment was largely China. So China is going through its period of digesting those excesses, those course correction, etc.
Okay, and give us a sense as to what the outlook is then in terms of your medium-term view for the markets. You continue to remain positive. Will it be earnings growth that will drive the long-term trajectory? Are the macros looking fairly robust?
So again, near-term view is, look, things are going to be soft and markets may be range-bound or slightly down. But if you take this time frame beyond 1 year, yes, we're positive. Because whatever the government's done on fiscal prudence, on these infrastructures, etc., that is going to give a flow to the growth. So globally, as we see things being soft, we're going to stand out in terms of 5-6% plus GDP growth. Nominal GDP growth would then be about a 10% plus. And I think that's where, again, these businesses will bounce back. The consumer will go through its own cycle. Being in a shell, they'll come out and spend money somewhere later this year, next year. So I think we remain positive on the names we've liked before: financials, industrials, consumption, real estate, hotels. I mean, there's a lot to pick in India.
Rahul, from Hong Kong, you're now in New York. Tell us what's the chatter around, the US presidential elections, because that's going to be the big event 2024.
Yeah. So I think if you look at what is happening in US presidential elections, is we've seen in recent months Trump come as a serious contender. There are talks that, okay, he may come and win also. So I think that gets its own policy unpredictability from a world perspective. Look, the US has done exceptionally well because there was a policy stability, and we all should appreciate what is happening in India because that gives policy stability. If you have policy stability, businesses are willing to invest for the long term, and I think that's the challenge US faces come next year, that there is going to be this whipsaw in terms of policy making, in terms of the noise which comes. So businesses may hold back investments, and I think that's where you will see more money coming to a country like India, more from a FDI, FI perspective, where you have strong macroeconomic policy making, where you have consistency of policy, and I think that's where the PLI, the 1 lakh crore which has come for R&D, etc., all those are small positive steps.
Okay, Rahul, great having you in the studios. You have a good India stay. Thanks for joining
Thanks
in.
for joining.
Thanks for having me.
Okay, let's move on.